Steve, you're in now. I can. We're live. We're live finally.
Yeah,
Took 7 minutes, but we got in there.
yeah. Well, it used to be that way, but I guess a lot of people, kind of contacted Twitter or X now, and they made the changeover about a month and a half ago. So it does work with the computer.
Oh, awesome, awesome. Good to hear. Yeah. So it wouldn't let me add you through Add Speaker, but then when I saw the list of everybody listening, then I could add you.
Oh, no kidding. Okay, well, I guess maybe they're still going through some growing pains, but
Yeah, yeah.
so it's finally nice to meet you. I know some of the our members, followers, asked to put us to do a chat. So I think it'll be interesting and a lot of things going on. And right now, we're in that kind of weak phase of the miners, and they go through these ups and downs, and so it's kind of frustrating, even in the metals. But I think there's much better times ahead.
Yeah, I have like 12 topics that we can talk about. First thing I wanted to see is how long you can go for. I can go for until 1:45.
And how is that 45 minutes?
Hour, well, no, an hour and 45, but it'd be,
Yeah, I could go for an hour, an hour plus, sure.
all right, excellent, excellent. So we're good for a long one. All right, so I want to start off with oil because that's an area you're really strong in.
Sure.
So let's start there. And I'm very bullish oil this decade, and I think you are as well. I studied peak oil back in the Matthew Simmons era when his book came
Yes.
out, Twilight in the Desert. I really loved that book, and I did a deep dive then. There was a website back then that was really popular. I forget the name of it. It was a peak oil website. I mean,
It was the oil drum, right?
yeah, the oil drum. That was beautiful, right? I love that. I
Yeah.
love that thing. That thing was fantastic. Um, and then it lasted about 5 years, and then peak oil, the tide oil came in, and it kind of went away. So yeah, so I want to start there with kind of the Matthew Simmons idea. So his idea was that there's just not going to be enough oil, and that we're going to reach peak oil, and we're going to basically we're going to get shortages because there's not going to be enough to go around. So I want to start with this idea of oil exports availability. So I'm hoping that you have these numbers on the top of your head. So if we go back and we look at the amount of oil exports from say 2019 to today, what does that chart look like? Is it flat? Is it still rising? And can it continue to rise?
Well, if we go by the monthly production and consumption, it hit a high in November 2018, and it has not surpassed that. It's trying to. Now, what's interesting, and this whole idea of peak oil is very complex because one of the things I get from a lot of people is, you guys been talking about peak oil forever and you've been wrong forever. And there is some kind of truth to that. But, the devil is in the details. And the details are, even though we're getting back up to close to the same number we were in 2019, it's different. We're actually producing, and you see the IEA, which is the International Energy Agency, goes by total liquids. And we've actually seen a decline in conventional oil production. And that's what really makes everything work. That's the good stuff. What we have made it up with, Don, is natural gas liquids and other things. And natural gas liquids, we could still use them. There's still petroleum, but it's about 60% the energy of a barrel of crude or of conventional oil. So what's been happening over the last decade or so, we're making it up with tight oil, oil sands, NGLs, natural gas liquids. And this is allowing business as usual to continue in the world. But the conventional oil actually peaked in 2006, about 75.5 million barrels. And it has been declining. And so this is the problem. This isn't, and that's going to continue to decline. And so the important thing to understand is that while we see these big numbers, 100 million barrels a day of production and consumption, they have the details, the quality of this energy has changed, especially in the last 15 years. And so we need to understand natural gas liquids does not produce diesel. And so what we're having a problem with now is diesel, and diesel runs the global supply chain. It doesn't matter if you make EVs and get rid of cars that run on gasoline. The issue, Don, is our global supply chain, the mining industry. Everything runs on diesel. Stuff that's transported, materials to a mine, that's done by trucks. That's done by rail. That's all powered by diesel. And so we're getting into the problem. We don't have a good enough high quality oil to produce enough diesel. And this is where we're kind of now stuck, I call it, in this plateau. So that's kind of where we're at, Don. That's the reason why we're seeing much higher prices. And I think we're in for much higher prices and also much higher volatility. They're going to go up and they're going to come back down, just like we're seeing it with natural gas.
Yeah, beautiful answer, Steve. I really liked it. I agree with you. I think that global exports have been plateauing, and there doesn't seem to be any producers out there to make it go up. And oil, if you look at the chart of oil production to global economic growth, it's almost a one-to-one correlation.
Yes.
If you don't have a growth, if you don't have growth in oil, and if you don't have growth in global oil exports, then you have a big problem economically. And that is the wall that I think we're running into right now. I think it really hits in 2025. And I so I want to get your thoughts. So I love the way you said that since 2006 to 2010, somewhere in there, conventional oil basically peaked and it hasn't been increasing. So the quality of our energy liquids has been declining. So that has a negative impact on supply. And so, we're at a point right now, and it's kind of one question I'm leading to. We're at a point right now where oil exports are not going to go up. I don't think, very much longer. I think it's like 12 to 24 months. We're like on a plateau. And if oil exports can't go up, the global economy cannot grow.
Yeah, and you see, this is very important because since the 2008 financial crisis, which it's gone by pretty quick. That was 15 years ago, 2008. Bear Stearns went under Lehman Brothers went under. We had the collapse of the U.S. housing market. It was really bad times. It's been 15 years. Since those 15 years, the world has added 12 million barrels a day of growth. 80 to 85% came from the United States. And unfortunately, that is getting ready to roll over because U.S. shale oil declines 42 to 45% a year. And you got to make that up every year. We lose 3.5 million barrels of oil every year just from the shale industry. So they go back in there. They got to drill all these thousands of wells just to get it back to even, just to get it back up to where it was on December. So and they've been doing that. We've been adding production, but that's going to become difficult. And there's really not a lot of supply elsewhere. We could see a few more million barrels. I don't think we're peaked quite out yet. We could see more. The issue is, I call it the Red Queen syndrome, and unfortunately, a lot of people aren't looking at this, especially in the industry, oil industry. According to my analysis, when you add up all these natural decline rates, again, 3.5 million barrels lost every year to U.S. shale oil, and that doesn't include natural gas liquids. That's just the oil, because the United States produces 6 million barrels a day of natural gas liquids. That declines 35% a year. So you start adding all this up. It's 10 to 11 million barrels a day that's lost every year now, and it's probably larger than that. And there's reasons for that. That's the natural decline rate. We need to make that up. We have to make up a Saudi Arabia every year now. And I think, as you said, my analysis is about 2025. It could be, there could be a little fluctuation there. It could be a little bit longer, but we're not talking decades. We're talking a year or two. This is a much different situation than 2008. When you can't add energy production, oil, as you said, we, this is really going to impact all that finance out there. I call it Ponzi finance, and this is the reason why I keep telling people it's very important to be in the precious metals and even the miners in the future, because a lot of this finance, the reason why this finance is in trouble, because we don't have enough energy to settle all the claims of this finance. It's 3 or 4 or 5 times the amount of claims on what the energy can support it. And it always comes back to the energy, Don.
Oh, absolutely. Economic growth and energy go hand in hand. That goes all the way back to the 18th century. It's always been that way. It always will be. It's energy and economic growth go basically a 1-to-1 correlation. So yeah, what people don't realize, I mean, you've done a ton more research than me, but I've done some. But what people don't realize is that the natural decline rate of oil, and it's not just conventional oil, as also, you mentioned it, shale oil as well, has now basically doubled. I mean, if you go back to, I think back to 2010, the decline rate was about 5%. Now it's at 10%. So we have to replace Saudi Arabia every single year. And we can't do that much longer. Maybe 1 year, maybe 2 years. Basically, the clock is ticking here, and people are really ignoring this. Now, I want to switch over to a new topic, which is basically the BRICS / Global South and how that's going to impact a lot of things. But the first thing that I want to talk about is how it's going to impact oil and oil exports. The Global South controls 80+% of global exports. And my feeling is that once there's not enough oil to go around, they're going to export that oil to their friends. And so, in other words, the US, if we don't have enough oil for ourselves, we have a problem. And I actually think they're going to charge a premium. They're going, oh, you want some oil? Well, here's your premium, $10 a barrel. What's your thoughts on that?
We could talk about this for quite a while, as you realize. And it is interesting. I've done some charts on the natural gas and oil, the regions, and I call it the net exports. And the two biggest, I hate to say this, the two biggest energy slaves in the world for natural gas is Europe, and then number 2 is Asia. For oil, it's Asia, and then the second is Europe. These two have the largest net imports of oil and gas in the world. And so when you understand that Russia, the CIS states, and the Middle East, that's where basically most of the net surplus oil and gas. Matter of fact, Russia and the CIS states account for 40% of all the surplus gas in the world. So if you want natural gas, you're going to have to get it from them. I don't care if it gets cut off there or in Europe. That's where the supply is, even though the United States has added more. So going forward, and one thing we haven't even discussed yet, the Middle East increased its own oil consumption 10% last year. So if the Saudis and Iranians and Iraqis are consuming more of their own oil, they can't export that oil. And so there's this double-edged sword that's taking place. It's called the net oil exports. Even if Saudi Arabia and the Middle East production stays the same, if they increase their energy consumption, which they're growing, right? You see all these huge metropolises in the UAE, and they're just growing like crazy. Well, that takes a lot of energy to run that. Well, even if they stay at the same production, they're consuming more of their oil. And that means less exports. Just on that one. What happens when their production starts to decline? And it will, the Middle East and OPEC. And so then it becomes a double-edged sword, because they're going to continue even increasing more domestic consumption of their oil. And if their production starts to decline, that it's a double whammy. That means there's much less energy exports, and the market isn't prepared for that. So yes, I think going forward, there's a lot of curveballs about this energy that the market is not really prepared for, and that's going to lead to much higher energy prices. And you're right, the BRICS control a large percentage of the net oil and gas exports. And I don't care. I put gasoline in my car. I don't put dollars. And it's very important for people to understand that we need goods, energy, and food. We don't need finance and currency. And I think the rest, these BRICS countries are really beginning to understand that principle because it hurts them when they have to use dollars.
Right. And what people don't realize is I think that energy, oil and natural gas, is a wedge that basically the BRICS can use against the US to push Europe away from the US. What I mean by this is that you just mentioned that Europe is kind of dependent on the BRICS oil and gas. It's the only place they can get it. And so, in order for them to be in the front line, in order for them to get good prices, they have to be on friendly terms with the BRICS. So this is a huge wedge issue, and I really think this is the reason why the Ukraine war actually happened. So now, how long can Europe basically kind of side with the U.S. against Russia? When does Europe have to basically pivot back to the BRICS, which Russia is a part of, and basically say, look, we want to be friends with you guys? Remember, France wanted to join the BRICS, and the BRICS said no. So at what point does the BRICS use that leverage and say, look, okay, fine, we will, we'll be on good terms with you, but you are allied with us, not with them. And they use that as a wedge against the U.S. because politically they don't want the U.S. to dominate them, which we have. We're basically the bully on the block. We are the superpower of the world. So energy is how the BRICS can use that leverage to basically create a level playing field. So I want you to answer that question and then also talk about the commodity bull market, what you think's coming there. That's kind of two big questions for you. And if I don't come back, if I don't come back online, I'm going to be back in 2 minutes. So you talk for at least 2 minutes.
Okay, I don't want to try to bore you guys, but you bring up a good point, and the issue is before the Russian-Ukraine war, Germany and Europe were receiving a lot of inexpensive natural gas pipeline. That's the cheapest way to go. When you've got to take natural gas or natural gas liquids, then you have to make it into LNG. It's you lose about 10% just making the LNG, and so it's a very expensive system to create the LNG. And then you got to buy a very expensive LNG carrier, a ship, and they cost twice as much as the largest oil carriers. And so you've got to do this, and then you've got to send it to Europe, and then you have to have a facility that will take the natural NGL and make it back to natural gas. It's very expensive to do this, and the prices are much higher, and that's kind of hurt Europe, especially Germany. And so what we've seen in the last year and a half, trying to muddle through this issue, is that they've really hurt a lot of some of their industrial base, but they've survived because unfortunately, green energy kind of performed well this year. The year before, it didn't. It really hurt them. This year, it performed better, but I think that's going to be a problem going forward. And so I think Europe is going to be hit with another round of shortages of natural gas. And so going forward, it's the leaders of Europe, not the European people. It's I would imagine many of the European people do not want a war with Russia. And so if they continue to push this, it's really going to hurt the European people more than the leaders. And so it depends when the European people are going to finally stand up and say, enough is enough. We need to all get together and get back to working on doing trade. And so until that happens, unfortunately, I think the Europe is going to be suffering even more. I think they're going to be hit with the next round of I call energy cliff with natural gas, and that'll probably happen in 2024. So, and about the commodity bull market, I think as we start going over what I call the energy cliff in 2025 with lower and lower energy production, a lot of this finance is going to get into trouble. And there's so much money supply out there. You're going to start to see institutions and high net worth individuals realize that they need to get into something to protect, because that finance is really not worth it. That's the issue. We're heading towards a global Bear Stearns event. So the finance out there is really not worth it right now. It's worth only about 10% of its value or less. So the wisest ones are going to start moving into real things. And that is the commodity bull market that we're going to see once we get this transition. It's still a little bit ahead of us, because I think we're going to see a downturn in the markets, or kind of a recession. But when we start to pull out of that, that's when I start to see the beginning stages of this commodity bull market, or the world actually going back to the physical economy, which is what we are. Finance I call it Ponzi finance. So I hope that answered your question, and I wonder if you're back.
Yes, I'm back. I got most of that answer. Um, so yeah, so we're basically both very bullish that oil, the energy problem, is going to lead to a commodity bull market, because oil impacts all the other commodities, because all the other commodities require energy to be produced. And so oil is it's kind of a unique, it's a very unique commodity, just like gold is a very unique commodity. Um, so yeah, so let's talk a little bit about gold and silver. Um, so for me, going forward, I think that we have one more kind of drawdown here on gold, and I don't know and then where the drawdown is going to come from. I think possibly started this week. Is that there's the stock market selling off, and selling off hard. I think that if we go below 4,200 on the S&P, I think we could go all the way down to 3,500. So I'm looking at this year, a 20 to 30% drawdown on the S&P this year, and I don't see how gold can fade that type of fierce selling. So I think I have my fingers crossed at 1,800 holds, because technically 1,800 is for me, it should hold because it has enough support. If it doesn't hold, that's kind of scary, because then you could go all the way down to low 1,700s, and then you can get into the 16s. Conceivably, you could go all the way back and retest this correction low of 1,615. So that's what I'm looking at. We already went below 1,900. I don't think that's going to hold. Um, I I spoke with Michael Oliver. He thinks it will. He's very bullish, but I don't. I think 1870, 1850 to me are just very I, I just think we're going to go through those. So I think we're going to land somewhere between 1,800, 1,825 is going to be this next correction low, and then I think that's the final correction low, and then gold is going to blast off, and conceivably, depending when we get a bottom, I think we could get an all-time high in gold this year, depending if we get it, say, before the middle of November. So those are my thoughts on gold. What are your thoughts?
Well, Don, we're pretty similar, because I do see a sell-off in the markets, but the sell-off in the markets may start. I mean, you could be right. We could see a large decline just in 2023, but I think it'll probably extend into 24. And so, because I think the recessionary forces are going to pick up, I think the housing market's in serious trouble. And so when you get more unemployment, it's like a feedback loop. And so the reason why I do think we can see lower gold and silver prices is because the COT report. When you get down to especially in silver, when the commercials become, let's say, net even, They were actually long 5,000 contracts at one point, and so that's when the silver price had gone down to 17 something. Uh, and so when the commercials get down to that, basically break that even in silver, that's when the kind of the low could be in. And we're at 32,000 net short positions. So there's some room if we get this sell off in the markets. And gold is the same way. And I would go on further to say, and I do things a little bit different at the SRS Rock Report, but my top gold miners, I did my total cost. This is not the all-in sustaining cost, and this is maybe where I differ from some analysts, is the total cost, the total realistic cost is about $1,700. Everything, the kitchen sink, with everything, it's 1,700. So that's where I think it would bounce off, and you get a real massive sell-off. Of course.
Looks like we lost Steve, or you lost me. One of the two. Can somebody text me if you can hear me or if you can hear Steve? Send me a DM. It was going great until just a minute ago. Steve is gone. Okay. Well, we got that one back. Let's see if we can get Steve back. While we're waiting for Steve, I'm going to talk a little bit about silver. So I just mentioned my my feelings about where gold's going. Now for silver, I think that um, I expect to retest 21 to 22 when this market finally sells off, say below 4,000. I think that, and then conceivably, I think 21, 22. But if it goes below 20, then we're probably going to go back and retest 18, which I don't want to do. 1800 gold, I think silver's going to follow gold. So as long as 1800 gold holds, I think we're fine. I think, basically we're getting ready to bounce. That to me is really the line in the sand. As long as 1800 holds, I don't see the HUI going much below 200. And I think a bull market is getting ready to start. But we're getting really close here. So as we approach the recession, um, which I think is kind of right around the corner here, because the Fed has raised rates. And so while we're waiting for Steve, I think maybe he was on his computer. Maybe his internet went down. I'm not sure. So I'm going to list some things, some reasons why I think that we're really close to a recession. I did my last newsletter. I did 23 reasons, but I'm going to do a kind of a top 10 here. So the first one is the inverted rates. You don't get this sharp of an inverted rate, um, uh, cycle or across the board. For this long and not get a recession, it would be really historically unusual. And the second one would be the lag effect in high rates. Those really haven't hit yet. And so when you combine those two, that's two significant reasons why it's going to be really hard to avoid a recession. The next one is the idea that Wall Street keeps saying that we're going to get a soft landing, but Wall Street's always wrong because Wall Street always is talking their book. So even though the sentiment is the stock market is strong, the consumer is strong, the jobs are strong, that's like a really loud voice coming out of Wall Street, but I really think they're being very selective in their data analysis. I think they're cherry picking the data. For instance, they are ignoring the inverted rates or ignoring the lag effect. The other thing that they're ignoring is the banks. So the banks, I feel, are currently in a credit contraction cycle where they're basically not making loans. Their balance sheets are a big mess because they they bought U.S. Treasuries at low interest rates, and now those treasuries are underwater. So their balance sheets are a mess, and so they're kind of going into credit contraction. They were already in credit contraction, if you think about it. In 2020, they really never came out of it. It's just gotten worse. Um, the next one would be the consumer is squeezed. So the consumer, SSR Rocco, I think you might be back.
Hey, Don, I'm so sorry. I was listening to the electricity got shut off at,
That's
I think
funny.
there was an accident down the road and they ran into a pole. And so, yeah, uh, it's so weird. So yeah, the power's
Yeah.
back on. I do apologize, but I was listening to what you were saying, and I actually, it's funny. I totally agree with you on your outlook of where the economy is going and the market, the broader markets. I really do. We see things eye to eye, even though it could take a little bit longer. These corrections could take longer or last longer in the broader markets. They're coming.
Yeah.
I think it's coming.
Right. For me, the trigger is going to be the stock market. I think that's what goes first. I think that is what causes the recession. And so, how long can the stock market kick the can down the road? You could absolutely be correct. So we're midway, 3 weeks into September, and I actually I didn't want to do this, but my gut feeling was that the market was going to retest 4,200 in September. We still got almost 10 days to go, and we're at 4,350. Got 150 points to go down. But my feeling was that if we retested 4,200 in September, that we would get the sell off in October. That the sell off, and there was a Zero Hedge today. There was actually an article from Morgan Stanley that said that the stock market is on the verge of triggering forced selling, and I think that is kind of what I'm seeing. So and I've also thought this, if we get through October without basically getting below 4,300, then I'm with you. We're probably going to have to wait until Q1 before, the market sells off. The market will basically find a way to get through Q4. So the next 6 weeks are going to be, for me, critical of when this recession starts. What are your thoughts on that?
Yeah, and it's difficult because a lot of things. It's so interesting. The markets have fundamentally changed since 2008. We've got all these ETFs, and I listened to Gordon T. Long, his interview with Adam Taggart, and he's a very smart guy when it comes to these markets, and we have no idea what's going to happen with these ETFs when there's a pretty big sell-off. They've really never been tested. They were a little bit during the pandemic shutdown, but and so there's so many things that are propping up this market, and there's so many people using leverage to buy puts and calls. It's the market has fundamentally changed in just 15 years, and it's actually similar to the gold and silver market. We didn't really have the GLD and the SLV and all these ETFs, so things have kind of changed in these markets. So we have to look at them differently, and so it is amazing how they continue to kind of float higher. And what I want the listeners to understand, back when we had the crash in 2008, gold and silver had gone up to their highs with the markets and even oil, right? And then everything started to come down. Well, silver at 23, my total cost, and again, this is my total cost for the primary silver miners is 21, $22 now. Now it could go below that, especially if oil prices fall. But the silver price is now back to is at a break even. where back in 2007, 2008, it was like $20 and it came all the way down to the nine. Well, that's where kind of the break even was to produce silver. It was about $9, $8, $9. The break even now is like 21, 22. So it's amazing that these markets could really fall and we could see a sell off in the metals too. But I think similar to what happened, the markets continue to decline in November and December. They didn't bottom till March, April 2009. What happened with the metals? They bottomed in October of 2008 and they started to take off. I see something very similar happening. And maybe you do too.
Right. I absolutely agree with you that you have to look at the markets differently. And I think that Wall Street is out to lunch, that they're basically treating it as business as normal. I saw a guy today. I record the halftime show on CNBC and watch it the first 10 minutes every day. And they had a guy on today, and he was talking about he invests for the long term for 3, 5, 7, 10 years. And I'm just rolling my eyes. Sometimes the comedy, because if you think that the U.S. is not in trouble here, and you're investing for 3, 5, 7 years, you're out to lunch, right? And he was he was absolutely, I don't know where that argument came from, but let's look a little bit about what has changed since say 2000, because this is how I analyze markets. I analyze markets from an historical perspective. So I go back all the way to the end of World War II, 1945, and you go from 45 to 70. You're going to analyze that section, and you go 70 to 80, and then the Reagan decade in the 80s, and then the 90s and the 2000s. So I analyze them basically in chunks. That's how I look at it. And I look at what the U.S. economy, what was the state of the U.S. economy during those eras, and what were we doing economically then, and then what are we doing now? And it's changed dramatically. If you go from that first section from 45 to 70, that was the golden era of the U.S. That's when the U.S. pretty much dominated the world. We were the envy of the world, especially in the 60s. We were building all these beautiful airports. They were all brand new back then, and now they're all old. But our standard of living was unbelievably high, and our political system worked. Everything was working great until 1971, and then all hell broke loose. And then you had that. That's when it all shifted in the 70s. That's when globalism was basically starting to rear its head. And then Reagan in the 80s, he brought it in. He brought in globalism, but he also brought in kind of the beginning of MMT, where basically the government was going to utilize debt to generate growth, generate our standard of living. Then we go into the 90s, and the Republicans were saying, oh, wait a minute, what Reagan was doing we can't do that. That's when Newt Gingrich basically balanced the budget, and he started the balancing. It takes years to do, and then Clinton got credit for it, but it was really Newt Gingrich's policies and the 93, 94, 95 that caused a balanced budget in 98, 99. But then the reason why that was the last era where the U.S. basically could grow, because that was the internet era, that was the high tech era, the 90s. But then we had the dot-com bubble. The dot-com bubble burst in 99, and then you had 9/11 hit in 2001, and that was really the end of the U.S. era. And we've basically been living off of debt. So in 2000, our national debt was less than $4 trillion. And so now it's 32. So we've been living off of debt. Debt's been increasing at a 10% rate. And then in 2008, and this is what Wall Street is totally ignoring, is that the U.S. changed its economic policies. We changed basically the role of the Fed. And this was basically Hank Paulson and Bernanke basically saying, okay, how much money do we need to spend to bail this thing out in 2008? And then if you look at the Fed's balance sheet, it was less than $1 trillion in 2000. Today it's like 8. So it's went up 8x. It's went up the same amount that our government's debt, from 4 trillion to 32. So both the government and the Fed have basically been using debt And this is the problem, is that there's no such thing as a free lunch. So if you go back to von Mises in the 1950s, he wrote a paper that if you create a bubble, an economic bubble through debt, you have to pay it off. There's no free lunch. And that's what the US has done. The US has used debt, and we think we get a free lunch, but we don't. And that debt is now raising its head, because now our interest payments on the debt is $1 trillion, and the Fed no longer has its tools. So I rambled there for about 5 minutes, and now I'll let you reply. Thanks for listening, Steve.
No, that was a pretty good summary, Don, from the 50s to now, especially after World War II. And I have a chart, and I wish I could show it, but maybe I'll put it on my Twitter feed later. But I went and looked at GDP, U.S. GDP, U.S. debt, public debt, and the energy consumption, total energy consumption. That's coal, oil, natural gas, all energy consumption. And I plotted it. Well, if you go from after World War II and you look at the debt is basically a red line that remains kind of flat up until 1980. It's kind of flat. What is going up in the same trend as the real US GDP is our energy growth, consumption. They're both mirroring each other. You hit 1980, we go through a recession, energy consumption falls, then it starts to pick up. Now let's go to 2008. It's been going up, but the debt starts to go up after 1980. The debt really starts to go up. That started to really generate more of the GDP. You hit 2008, and that's right. That debt goes up exponentially. So we are using debt now to generate GDP. And unfortunately, like you said, that debt won't be repaid, and it always comes back to the energy. The finance has massively separated from the physical economy. We don't need finance. We need energy. We need food. We need goods. We don't need the finance. The finance steers the economy. The energy drives it. And so the finance is supposed to help the liquidity of the market. But when you're adding all this finance, that the energy cannot support it, that's when you get into trouble. And so I think when you add 1.5 trillion of new debt since the debt ceiling was raised, which was June 1st, in 3.5 months, that's also keeping the markets up. I mean, this is a massive amount of stimulus. And so I think going forward, where the US government, the Treasury, is going to have problems trying to issue more of this debt, more of these treasuries. And I've got a chart, Don. If you go back to the 1970s and you look at the US annual deficits cumulative, and you go to 2022, our money supply, which is 20 trillion, equals the cumulative annual deficits. And so we basically have financed our deficits with the money supply, and that was treasuries. And so this is where we are now. Yes, it can continue for a while, but you cannot look at the treasury market today as some of these financial guys look at the treasury market and the yields and the bonds, where the bond yields are going to go in the next years, like you did in 2008 or like you did in 1980 or 1990. This is a massive bubble bond market. And so you've got to look at it much differently. And unfortunately, Wall Street, the financial economists, they look at it as it's the same as it was 15 years ago, and it isn't. And unfortunately, I'll end here. At least in 2008, when we added all this debt, when we added all those treasuries, we added 12 million barrels a day of oil growth. You cannot continue to add debt and treasuries if you don't have the energy growth, and we're not going to have it. So this is the problem the world is facing. That's why it's important to be in these precious metals. It is very important to be in these precious metals.
Hey,
Right.
hey guys, this is Nicholas from FMT. Yeah, Steve, I concur with you. And one of the things that's interesting about this conversation, what's very good, by the way, is how, Don, the way you break down the eras and the cycles, I think is really spot on. Because when you look at those eras, say from like 1945 to 1970, we had an we had an abundance of energy. Not only in 45 did we um, strike a deal with Saudi Arabia for oil imports, but we'd also just gotten over a capex cycle from 1930 to 1940ish for energy. I mean, people forget this, but oil, gold, silver, real assets were the only thing that protected your wealth, even through the Great Depression and the deflationary crash. And so it's incredible to think that investing in things that seem cyclical to the economy actually would have protected wealth even in a deflationary crash. But then uh, you go through these long underinvestment cycles in energy, um, and during those underinvestment, our surpluses get worked off, and as they get worked off, you get these crazy financial bubbles, like leading, like roaring 20s and leading up to 1929, where energy in the 20s commodities were neglected. What we had an abundance at that point, but it built up until the 1929 financial bubble and speculation. And I think the Dow dropped 86% from 1929 to 1933. Yet through this period, overall, you would have protected your wealth. I think it was a real return of 190% from 1930 to 1940. And if you stretch it out to 1945, 1946, I believe your real return increased to over 300%. But then, that whole cycle, that whole era, we increased capex and energy production in the 1945, the Great Deal with Saudi Arabia, and yeah, that 1945 to 1970 era was unbelievable. I think that was a great era of the drive-ins and diner drive-ins and drive-in movies, and I think just in those 2 years, 1945, 1947, we increased the amount of cars that were sold into the population was, I believe, around 15 million new cars were sold in just those 2 years. I mean, we're at this point swimming in oil and everything's great, but like in every era, we have this abundance that we neglect. Capital cycle capex goes down for new production. Um, and this leads to, the mother of all bubbles in 1969, 1970. That's when Buffett literally left the financial markets and quit his partnership. He's like, I'm out. This market doesn't make sense to me. He didn't re-enter publicly traded stocks for another 4 or 5 years. And so the point though is every cycle between abundance energy and a deficit energy has ultimately led to major commodity bull market, which we're probably entering. I'll stop in a moment, but the point I want to make is we just got through a very long underinvestment period in energy, and what probably marks this time a little different than the previous cycles is I think it goes to what Steve is saying, but where is our capex? Where is the growth in energy production going to come from? When you look around the world, uh, even if we start making the investments and reinvestments we need in new growth capex for energy production to increase energy production because of the Red Queen syndrome, because of the compounded average decline rate of these wells, which are extreme, especially in the shale. Where is the new oil going to come from? And so, to me, I'm not afraid or I'm not fearful of a recession. What I'm afraid of is what's going to happen to commodity prices, um, and just exactly where the prices are heading over the next few years, because I think it's going to be astronomical.
Okay, I have four points. So I have 4 points to make about to comment on what you said. The first is that the Fed. This is a whole new era. It's like the past doesn't really. We can't use the past as a foundation to go forward, if you will. We're going to need a new way out. And the first problem that we're going to hit, and I don't see any way we can avoid this, is that the Fed cannot basically monetize our debt. So it can't monetize, say, 70, 80% of our debt needs. And so it's going to be forced to do a reset once basically foreigners won't buy our debt. Once they realize that we're screwed. And I think that's going to happen, say, 2026, 2027, one of those 2 years, we're basically going to need a reset. I think it's going to be 27, but it could happen as much as 26 because we just have too much debt, and it's kind of like a corporation. We're basically bankrupt. Number two is, if we go back into the 30s, since you mentioned the 30s, homestake mining was probably one of the best investments you can make, the gold miners. Then if you go into the 70s, which is somewhat similar to what we're having now, there was a lot of 50 baggers in the 70s. And so I think we're going to see that same outcome here. Point number three is that oil in the economy, and I'm glad that Steve and I were together, that we could kind of talk about oil, gold, and the economy, is that they're so tightly connected. And so when you get, basically no more, we don't have cheap energy, and the economy is kind of, impacted by too much debt, and we're over leveraged. This is a really bad combination. And then and then you add to that the political problems that we have in this country, where basically the Democrats and Republicans no longer talk to each other, let alone try to agree on anything. And then my fourth point is, so you said, where does this lead? Well, I think unless we have a new cheap energy invention, I don't think it's going to be oil. Some type of an invention is going to happen really, really quickly, and I think the chances of that are pretty, very, very, very low. But I do think we'll probably have something in a few years. But heading into this recession, to finish my thought here, and Steve can talk. Heading into this recession, if you really connect the dots, it's nasty. It's really, really nasty. So how does the Fed, for instance, get going? If we go into recession, how are they going to get this economy back on its feet again with low inflation, without hurting the consumer, when the consumer already, the average family, 56% are living paycheck to paycheck. It's going to get worse. So we're kind of heading into kind of a whirlwind, a storm, if you will, for the country that's been building since 2001. And I actually think that what's coming is there isn't going to be answers. The only way forward, if you will, the only option forward, I think we're going to realize it soon, is that we have to do something different. We have to do something new. And that's a very strange outcome. Over to you, Steve.
Yeah, Don, we have been here before. We forgot our history. And I've mentioned this in some of my interviews and Twitter spaces, is that the Romans and the ancient civilizations, and I didn't know this up until a few years ago, and it's common sense. They cut down forests to make charcoal to smelt metals. In the Bronze Age, the early, late Bronze Age, then they moved into iron. And so it took a massive amount of wood to produce these metals. And then, of course, you've got to build warships, and you've got to, for military, and how much wood they used in the Roman Empire to heat and cook, and for construction. So they ran into trouble with their wood production. And that's the reason why we see the collapse of the Roman Empire. It wasn't due to the debasement of the silver denarius. It was due to the collapse of their wood production. And when you have the collapse of wood production, you get the collapse of metal production. It's always been the energy first. Yeah, and right now, a barrel of oil is about 5 years worth of human labor. And people don't realize how much energy that is. And so the machines do all the work. We just kind of steer them around. So moving forward, the issue is, FMT Investment brought this up. There isn't enough capital investment. And it is true in energy. The problem is, when we were spending a good bit of money on oil exploration, when we weren't finding enough. So now we're burning 5 barrels of oil for every 1 barrel we find. And you don't need to be a nuclear physicist to figure out that that doesn't continue to last long. So even a decade ago, it was about 4 barrels we were consuming. A decade before that, it was about 2.5. So it's just gotten worse. And yes, we're spending money on wind and solar, and that doesn't help the oil industry. The issue is there's no coincidence that the Russians are in the Arctic looking for oil if we're having problems finding oil. And even though there's still oil to be found, we're just burning 30 billion barrels of it a year. And so the issue going forward, the rubber hits the road when we can no longer replace the decline rate, which is 10 to 11 million barrels a day. And when that happens, all the central banks are going to have to, like Don, like you said, they're going to have to do something new because it's no longer going to work. It's actually getting there. And so we're all this volatility, all these problems with the UK gilt market almost blowing up. This is the EKG of the world getting ready to die of this financial system. And what we transition to is going to be more physical backed. I'm not quite sure how that is, but this finance is not going to work much longer. It still may take some time. And so that's the reason why the commodity bull market or the precious metals and the real things are going to be the bid. That's where finance is going to start moving to. And so that's how I see things playing out. But we may have a recession first. We may get, like you said, Don, we may get this one recession pull and things go into a decline. And lastly, we're moving towards inflation of things that you buy with cash. We're going to see deflation in things you finance. And that's stocks. I mean, that's real estate. That's all the businesses are going to see deflation, all the assets. But things we consume are going to really have massive inflation in the future.
Yeah, I'd like to point out on the energy situation that's going on right now. WTI oil has gone from $70 in June to roughly $90 today, and over the last 2.5 months. And at the same time, the Permian produced less in August. It's on its way to produce less in September, and it's going to produce less in October. This is and plus I think rigs dropped by 6 last month. This is the first time since really the Shell Permian really took off in 15 years that we've seen a decline in production in over 3 months, as oil has essentially skyrocketed over 30%. And I think this is a function of two things and why the problem is going to even be worse with energy, barring even the energy return on energy invested issues of taking, 5 barrels of oil to, find one or to create one. Is that we have two problems right now. Is one, the oil companies are dirt cheap if you look at their PV10s, their present value discounted based on their proven reserves and their developing producing reserves, they're dirt cheap, selling well below their present value tens. And that's not accounting their actual assets they own, whether it might be pipelines, equipment, rigs, those types of things. And so these companies are paying down their debt, they're increasing their dividends, they're buying back their stock. But one of the things they're not doing is because they're not incentivized to go grow production. But the other big thing, I think it's even bigger, is we have an anti-Fed policy with a high capital cost so that increases the hurdle rate on top of the ERIL problem. But the other thing is we have an administration that's even worse, because every time we have high oil prices, their solutions are temporary and have a long-term negative effect on future production being higher, whether it's them threatening more SPR releases. Well, what's that tell the producers? Keep just buying back stock with the free cash flow, keep paying higher dividends, keep paying off your debt. But God forbid, don't go look for more oil because you'll be penalized. You're already being penalized based on your reserves selling at a discount. But this administration is, also threatening windfall profit taxes, bad for producers, right? Everything this administration proposes is anti fossil fuel or the producers themselves. And so they have no incentive. And who know, like their incentive may just have to be $150 to $200 oil prices to be like, okay, they've been over 100 for 6 months, a year now. So at these at these rates of return that we can get for producing more or trying to produce more, we're willing to put some money into it. Some of these extreme cash flows that we're developing, but I think it's a huge impediment. And the other thing I'd like to just add, because a lot of Fed Reserve discussions have been brought up, during the 70s, we had, Project Independence under Nixon. We created 55 nuclear reactors in just that decade alone. We had everything like that's where speed limits dropped, and we created speed limits and efficiency levels for cars, to increase efficiency on gas mileage and all these issues, odd and even days. We went through an entire decade of odd and even. And while everyone looks back and say, oh, Powell doesn't want to do what Arthur Burns. Powell needs to do an Arthur Burns. He can't be Volcker. When Volcker came into office, we went over a decade of massive capex, project independence, everything we needed to do to create more energy independence and an abundance of energy. When Volcker came in, we can't slam the brakes on by increasing interest rates, making the cost and the hurdle to go develop more and produce more oil now even more restrictive, on top of having these completely hostile um, uh, 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 Biden administration towards more fossil fuel production. During the State of the Union, when he said, we're going to need at least fossil fuels for another 10 years, his entire constituency base went on this they all had these huge boos, like boo, like, and all he said was, we're going to need fossil fuels for at least 10 more years. And we all know we need fossil fuels for ever. But the fact that he just said we'll need them for 10 years, you can see that his constituency base, how anti they are, and the problems this administration also has based on their base. And so I just see like a massive, massive looming energy crisis that the world is completely sleeping on.
Yeah, I think we all three agree on that. That there is an energy crisis that's looming. And I don't think there's a solution for it. I don't think that investment um, by the big oil majors or all the countries, I don't think that that's going to solve it. As a matter of fact, it takes a long time from discovery of an oil field to production. It doesn't happen overnight. So adding, when you have to add a new Saudi Arabia, which is 10 million barrels a day every year, where are you going to find that? It's a massive undertaking, and just to find it alone, I don't think the oil reserves are there. So I don't see a solution for oil in the near future. You know, even if the cost went up, they always say price is always the solution. Higher prices will create investment into oil, and I don't see that now. Venezuela has a lot of reserves, but the problem is it's not economic until I don't know $135 oil or higher. So you're not going to get cheap energy. Cheap energy, and Steve mentioned it earlier. We really haven't. Cheap energy has been on a decline since 2007, 2010 era, and now it's not coming back. So we know we have an energy problem, and we know we have a debt problem, and so everything is kind of coming to hitting a wall here. And so for me, I think the key to it all is the U.S. economy, which is the largest economy. So if the U.S. economy, and this is where the rest of the world is somewhat dependent on our treasuries because it's always been the safest debt. So what happens if that sentiment changes? It really turns, the entire tone of the last, I don't know, 20, 30 years of international finance. If countries cannot depend on basically buying our debt, where do they put their money? They put them, Europe isn't a great place. Japan, where do you buy debt? And so that becomes a big problem. So let's go back to gold. I see, we have the global stock market is over 100 trillion. The global bond market is over 100 trillion. So that's 200 trillion plus. And I think 250 trillion is probably a good number for money that's currently invested in stocks and bonds. So all we need is a small portion of that money to move into gold, to push gold to 3,000 plus. I don't see a scenario where that doesn't happen. Let you guys talk about that question. How does gold not go to 3,000 in the near term?
Well, I try not to do the crystal ball on when these metals are going to hit their prices, because you try to do that and it becomes very frustrating. But when I do see technical setups, then I know that they could break either direct in a direction. And we all tend to find the technicals. But I looked at the silver and gold price, and I put it a decade average silver price, decade average gold price, and I compared it to the oil price. Over a decade, we're not talking a year, we're not talking quarterly, we're talking decades. And then when you do that, you could see that it's the oil price based on the devaluation of the dollar that's really setting the price of these metals. And so when you look that, I found for silver to hit 35, we would need to see a sustained oil price of $150. For gold to hit 3,000, we would need to see a sustained oil price of $150. A sustained oil price, because you have to remember, when you went back to 1970, the price of oil was $1.80. It went to $36 by 1980. It went up 15 times. Gold went up 15 times. Average annual prices. Silver went up 16 times. So this is just my back of the envelope calculation, just based upon the energy inflation. Now, Don, there's going to be another factor that's actually going to be even larger. And that's going to be when the markets understand what real collateral is. Because right now, if you and I want to buy something, we want to get a loan, most people use either their business or their home equity as collateral. Well, do you know what the financial institutions use? U.S. Treasuries. That's the collateral. It's insane that we use debt to generate more debt. And it's one thing when you have 5 trillion of outstanding treasuries. Now you've got 25 trillion of outstanding treasuries. And so what's going to happen is the market, the BRICS, the market, the institutions are going to start, this collateral that used to work because of the energy growth is no longer going to work.
Right. Let me cut you off and then you can come back in. You said that you thought that oil, in order for silver to get to 35, oil had to get to 150. That's historical. However, I think this is a whole new ball game because you just mentioned collateral. So I mentioned the $250 trillion in assets, and I agree with you that those assets are going to be deflationary. But a lot of that big chunk in assets is collateral. So the reason why I think that silver will fly past 35 is because of this new era, this new problem of this collateral problem, this debt problem. What I call it is the fear factor. And what fear is going to drive silver to the moon, drive gold to the moon, because the whole system is breaking down. The collateral is breaking down. So I don't correlate, historical oil to gold, oil to silver. I correlate we're in a new era. Your turn.
Yeah, and you're speaking to the choir. And what I was doing was just trying to show where we've been and where we're going. If we're going to see oil inflation, that would be kind of the foundation. But I do agree, because we're not going to have the growth in energy, a lot of that finance out there, I call it Ponzi finance. The global GDP is about 80 trillion, 82 trillion. Do you know that the currencies and the interest rate swaps, they trade 600 trillion a day? This stuff is just obnoxious how much it is trading. So I do agree with you that there is, we're going to move to the problem with collateral, and gold and silver provide that collateral, and there's a reason for that. Now, I hear something in your background. I don't know who that is, but I hear something in the background.
Yeah, I think that's FMT. He's off now. Go ahead.
Okay, but the idea of what collateral really is, even real estate equity in the future is not going to be good collateral. Because when you start thinking about it, and people need to start thinking about it, what gives real estate its value? It's economic activity. Let's say in a local area, you've got homes, you got businesses. And if you have people driving around, trucks driving around, goods moving around, what happens when you lose 10% of that oil?
This is, okay, sorry to cut you off, but I mean, this is the heart of the whole conversation. This is the reason why we wanted to talk. We've been leading to this point, and the point is this, is that things are going to, everything, I mean, if you connect the dots with energy, with debt, with politics, with history, everything is pointing to we're getting ready to hit a wall. We could be wrong, but everything's pointing to it. And if we're right, gold and silver should be the best. I don't know if the best is the right word. They should benefit from this outcome in a big way. This is why I have $100 silver as a conservative number. And if you listen to this whole conversation, you'll see why I think it's a conservative number. The only way I see silver not getting to 100 is the government intervenes. Your thoughts on that, Steve?
Well, I don't like to put numbers on it, but I do agree with you because there's about the same amount of above ground silver investment as there's gold investment. There's about, well, actually, it's about double. It's about 5 billion plus ounces of silver and about 2.6 billion ounces of gold. And so when institutions or investors try to access that, just like they want to buy treasuries, right? You want to buy treasuries and get a 5% yield. When they try to access that high quality collateral, there's just, we can't create another 1.5 trillion in treasuries or another 1.5 trillion in silver like we can treasuries. We can't do that. And so I do agree with you going forward. And the reason why gold and silver are better, higher quality collateral, gold is better than silver, but silver's still very good too, is that gold and silver store this energy value. Because that's all we do, Don, is we burn energy, we create goods and services. That's all the economy is.
Right.
And so when you understand that money is a store of energy value, that's what gold and silver do. Gold just takes 100 times more energy to produce it than silver. That's the reason why the price is so much higher. It always comes down to all the energy, not just oil, not just natural gas, labor, materials, all those things. And so I agree with you. When you start to get people concerned about the collateral, in time, they're going to have to move into real physical collateral. And that's going to take some time. But when it does, there's just not that much of it compared to the trillions out there that is fake collateral.
You're spot on, absolutely spot on. And this is the reason why gold and silver are going to basically be rocket ships. It's because they are kind of real collateral. Now, you mentioned 5 billion ounces of silver. Now, for me, I think the most important number, and this is the reason why I only stack silver and I don't stack gold. The most important number is the number of 1,000 ounce bars, because 1,000 ounce bars is what industry uses. The number of 1,000 ounce bars that are above ground and are for sale today, I think that number is well less than 1 billion ounces, if you will. It's a tiny number. I would say it's more like 50 million ounces, maybe. It's probably less than that, maybe 20, 25 million ounces. But the number of pallets out there of 1,000 ounce bars that somebody could buy. So Eric Sprott, when he created PSLV, he raised 90 million ounces, and he could only find 60 for sale. That was then. I don't think there's 60 for sale today. I think it's more like 20, 30 for sale. And so those 1,000 ounce bars, once they're gone, once you have no inventory basically above ground, and somebody goes out there and tries to buy, 500,000 ounces or whatever, and they can't find it, all they can do is put an order in and wait for it to come out of the ground. Now, okay, so Steve, my estimate, and you can't get this on the internet. Nobody knows. The guys that actually do the research on this can't give me a number, but your gut feeling, 1,000 ounce bars right now for sale, if you were starting an ETF and you needed 50 million ounces of silver, could you find it?
You see, that's it. That's an interesting question because look what happened last year when we had a large demand, not only in the retail bullion products. Indian demand was really very high. They had over 1,000 metric tons. I think it was in July or August. And so what did we see? We saw the LBMA draw down. And so, yes, while you see, I think there's actually over 1 billion ounces. There's there of one
and 1,000 ounce bars for sale? No way.
No. In inventory.
No, I'm talking. Forget about inventory. Yeah, there's plenty, well over 1 billion in inventory. Well, you're talking 2 billion in inventory. I'm saying for sale. How many 1,000 ounce bars are for sale and wholesale?
Well, I think it's tighter. It depends for sale for what price and how quickly. But so the thing is, when you start, that's why the price will go up. When you start seeing it, like because BlackRock decided to take a 20 million share stake, 21 million share stake in the PSLV in the last 2 quarters. That's about 7 million ounces of silver.
Right.
And so the thing is, yes, if someone came in and said, "I want 100 million," they're going to move the market.
By the way, they can take delivery of that if they want.
Yeah, it's a process. But the thing is, I think most people most institutions that get into the SLV, all kinds of institutions, they do it because they want to get access to the silver price. You see, most of us could really give a rat's ass about silver,
right?
Because it's if you're going to have 1,000 ounce bar, I mean, to haul that thing around, what we all care about is the movement of the price of silver. That's what we all care about. And institutions are the same way. So all they want to do is people say, well, they can't sell that silver in the SLV. Well, they don't want it. They don't want to take delivery of the silver. They want to take delivery of the profits.
Right. So let's
I'd like to add real quick to that, since I'm in the money management business. I care about price, but I also care about margin of safety and protection even more in some ways, right? Because being a good investor is protecting your downside. And so when I just recently wrote an article on my website, but one of the things I said is I really believe that silver presents one of the largest margins of safety of any asset in the world today. I think Steve has pointed out plenty of times that the silver price is barely above the cost of production. I mean, like barely. And that's given, with oil where it's at today, given that I believe we're looking at a looming energy crisis, silver historically has followed sort of the price of oil. I mean, at least over the last 100 years that I can tell. And so barring some sort of spike low just because of a major recession or major credit event, I'm not concerned about that, because ultimately the powers that be, if they want to even remotely keep this thing running, they're going to have to continue to deficit spend. They're going to have to continue to, the Fed will end up having to mop up more treasuries, whatever it may be. But from creating the complete collapse of credit, they'll be back in one way or the other. I mean, and so when I look at silver, I don't know the upside, but I know the downside. And I know the downside is so extremely limited. And the upside is potentially asymmetric. I mean, I believe that the last count I saw is we're producing about, it's about a 7-to-1 ratio of the Earth's crust. We're producing about 7 ounces of silver for every ounce of gold, but the silver to gold ratio is like 80. and I believe demand's much higher than 7-1 for silver over gold. Eventually, like, the stockpiles are gone, and when Don says, can we even get $50 million worth of 1,000-pound bars of silver? I believe him.
Ounce.
Ounces. I'm sorry. I'm sorry, but I think you're onto something, because I can't figure out where the excess stockpiles of silver is coming from. I mean, I cannot figure it out. It's been going on for how long?
Well, it's actually kind of, I think, kind of easy to get that number, because you just go back to the PSLV. What Eric Sprott told us, he basically said, he needed 90, he could only find 60. Is that pretty?
Wow.
And then the final 30 all came from the ground. The final 30, it was all dated the year that he ordered it. And so they basically had to wait for it to come out of the ground. And it's like ordering on AppMix and they're out of inventory. You got to wait till it comes in. That's kind of the situation. So inventory is tight. I'm certain of it. It's tight. And so I think what's going to happen, and this is where it gets really interesting, is that I think that you can take delivery off of PSLV and you can take delivery off of SLV, but only if you own a ton. Literally 1 ton. That's kind of the minimum that they will deliver. But their big customers can take delivery.
I believe in dollar terms, it's about $470,000, just for what it's worth on PSLV.
Yeah. It's a big chunk of money. But so what I think is going to happen, and this is what's going to drive the price to the moon, is that you're going to start seeing these drawdowns, not now, but when silver, basically these shortages occur, when these companies can't find silver, they're going to start buying PSLV and SLV to get a position so they can take delivery and basically of these things. And so once you start seeing people take delivery off of it, you start seeing we'll see it. We'll see the movement. The price will be going up, but basically people, when they take delivery, they're going to have to pay a premium. It's almost like they're doing a buy. And that's going to be a kind of an indicator that there's a supply problem. And then I think what's going to happen is there's literally going to be there's going to be a shortage where somebody is going to shut down some manufacturing plant, and there's going to be a news release saying, sorry, we got to shut down. We can't find any silver. And when that happens, it's silver to the moon time. And I really think that's going to be the outcome. Your thoughts, guys?
Well, I've been in the silver market, and I can get excited about it because I'm a big believer in silver more than gold, due to there's just not a lot of silver. But I try to moderate it's going to go to the moon, because and I'm not saying this against you, but there's plenty of analysts in our community that say that they say that over and over again, and they scare people into buying metal. And then what happens? Silver goes to 30. It's going to the moon, and then it comes back down to $17. And what have you done? You've destroyed that new investor's confidence in silver. What I try, and I know you do too, Don, is I'm looking more at a fundamental change in the world financial system due to the energy problems we're facing, and what is real value, what's real collateral. And so, and I agree with you. How this unfolds, I don't know all the details, but interestingly, people think that there's going to be a shortage of silver in these ETFs. I actually think when there's a lot of demand for it and the price goes up, the metal's going to flow into the ETFs. Because when you look at the GLD, and when you look at the gold ETFs, and you take the gold price and you plot it over it, and the World Gold Council shows it,
all right,
the gold price moves up and down with the inventories of the ETFs. And so what I'm saying is, if I'm an institution and I've got 50 mil, I'm not going to go call up a dealer and ask for 50, gold eagles. I'm going to go and I should probably buy the gold physical and store it somewhere. But most institutions who they have clients, they can't buy gold and silver. They really don't. And they can't buy futures either. So what do? They can buy stocks, and they can buy bonds, And so where can you get access to gold and silver? It's on the ETFs. So I actually think the fireworks are going to happen in the ETFs and in the retail buying. It's going to happen all at the same time. And I actually think in the future, they're not going to be able to get enough metal. So I do agree with you. There
Right.
won't be enough metal to meet the demand, and that's going to cause a lot of problems in the ETF markets. You're going to see
Right.
premiums in these ETFs because
Right.
they're not going to be able to get the metal.
Right. I think it's not smart to invest in silver unless you see kind of the whole picture, if you will. If you're only investing in silver because you think there's not enough silver, there's a shortage, going to be a shortage of silver, so I want to buy silver, or I want to buy silver because it's going to protect me from inflation. I think those arguments are the wrong arguments. I think me and you have the right argument. Your argument is kind of this: the financial system in tandem with the energy issue crisis. And for me, my approach, I come at it from a little bit different angle. For me, it's all about the debt bubble and which Reagan kind of kicked into gear, and this whole idea of MMT working. I just think that MMT is Ponzi, not Ponzi. It's kind of like voodoo economics, if you will. It's kind of insanity economics. And so I think that debt bubble, that's why I'm in it. So I'm going to wait. I think the debt bubble eventually impacts the U.S. economy, which creates a fear trade, which leads to higher gold and silver prices. That's my angle. And so everything else is extra. Lack of high energy prices, not enough silver inventory. Those are extra. It's the debt bubble and the belief that debt bubble is going to eventually lead to higher gold and silver prices. Your thoughts?
Yeah, I agree. And what's interesting? When conventional oil peaked in 2006, there's no coincidence we hit 145 oil in 2008. And so when you understand, and then there's no coincidence that the global debt has doubled or more than doubled from 150 to 300 trillion since 2008. It's all due to the energy. Yes, we brought on shale oil and we've increased production, but it's a lower energy return on investment. So I just want the listeners to understand the debt wasn't added just because people were bored. The emperors in Rome didn't debase the Roman silver denarius because they had nothing better to do. They debased the currency because their wood production was falling, and the easiest way to continue the Roman Empire was to debase the currency. The central banks are doing the same damn thing. It's just the falling energy return on investment of oil and energy. They're using debt to prop up the system. And now they're using a massive amount of debt. So yes, I do agree with you, Don. The debt increase isn't happening out of thin air. The debt increase is reaction to the problems we're having with energy and to try to continue business as usual in a world that we really can't do that. And so I just want your listeners to understand that that is the driver of all this debt, is the problems with energy.
Right. And so that debt bubble, if you will, in my opinion, that we're driving has, again, opinion, belief, you can, whatever, has a bad outcome. And that bad outcome leads to higher gold and silver prices. That's my thesis. Now, if we go back to 2004 to 2011, oil prices were going up. That's when we got, very cheap oil back in the early 2000s, and then oil went all the way to $100. And so we're experiencing the same thing today, where I think oil is going to go up to $200. So as oil goes from, today about 90 to 200, that is going to drive, that's going to correlate, I believe, with higher gold and silver prices. It's almost similar to what happened in the first decade of this century. I think we're going to repeat it. And, I think that once gold kind of kicks into gear here and does its next run, that oil is also going to come along for the ride. I think you would agree with that, Steve.
Yes, and you see, when I mentioned that there's like 600 trillion that's traded every day in the currency and interest rate markets, A lot of that is structured on a system that isn't too volatile. So when you had the UK gilt market blow up earlier this year, people think, well, that's just a one and done. And then we had our banks go, some of our banks went bankrupt. This is not over. And so as the energy gets more problematic and they add even more leverage and more finance, the volatility that we're going to hit is going to really destroy a lot of this leverage in the CDS, in these interest rate swaps, because they're set up on a system. And if you watch the movie Margin Call, that's what happened, is that when you start getting the volatility outside a certain level, then a lot of the asset value just is gone overnight. And that's what they were facing in 2008. And now we've done it on steroids globally. And so I don't mean to kind of be a doom and gloomer, but this is what we're facing. And we don't have the energy growth to kind of paper it over. And so the energy problems are just going to make the volatility in the entire system much worse. And that's not good for all this Ponzi finance we have. And so, yeah, I totally agree, Don. That's the main reason, and I agree with you, to be in these metals, not because of the cost of production, but due to the problems with the finance.
Since you mentioned margin call, I actually think that it's actually fairly interesting. The plot of that movie, I think it was in the 70s, right? Late 70s, maybe early 80s. The whole plot of that movie was that Saudi Arabia was selling their treasuries and buying gold. And and that very well could happen again, where countries that have our reserves right now sell their treasuries and buy gold, because you're going to sell the treasuries in dollars, and dollars are what you use to buy gold. So it's I think that thesis actually could come to pass. What do you think?
You see, when you can, and I did the numbers. I did the numbers. It took the global gold mining industry 8 years to produce the gold, and I base it about 115 million ounces a year. The value of that is 220 billion. It took 8 years for the gold mining industry to provide gold, which central banks have, which is collateral too. What the U.S. Treasury added in new Treasury issuance, new debt, in just 3 months. So when you understand we are a physical economy, we eat food, we use energy, we use goods. When you can add 8 years worth of gold production value in 3 months, the market is going to realize that's not sustainable. And so it always comes back to the energy, the energy and the manpower and the capital that it took and the materials to produce all that gold in 8 years. And it's still there. It kind of holds all that energy value that it took to make it. The treasury is an IOU.
Right.
Now, you see, here's the problem. The gold is still there. That gold is like 1.5 trillion in gold. It's still there. The treasury is an IOU. It's got to be paid back. And so the one is a debt. The other is an asset. So I agree with you. The treasury really isn't an asset. It's a debt. And it backstops all our dollars, right? Our debt backstops all our currency. And so, yeah, this is the issue. It's been going on for quite a long time, but we don't have the energy growth to allow this to continue for much longer. And I see really big problems happening after 2023, even though we could start seeing them much sooner. 2025, that's my energy cliff date.
Yeah, I'm using 2025 as well as for when the commodity bull market begins. I see 2024 as the last year of Easy Street in America. We basically have about 12 months, maybe 16, But I think we have, let's say, 8 to 16 months left of what I call easy street, where basically life, our standard of living is as we've known it. And then once we hit this wall, I think everything's going to break down. It's going to be, we're going to go into kind of a terminal decline towards the breakup of the country, which I expect to happen before the end of the decade. So this is, this, in many respects, this is going to be the worst recession since the Depression, if you will. And it's going to feel like the Depression for most people. That's my take. I do not see this as a normal business cycle. I do not see this coming recession as a normal recession where we just go down for 6-12 months and then come out of it. I do not expect that outcome. If that's the outcome, then gold's going to sniff it out and will not go to $2,500. But if I'm right, next year we will go to $2,500 because gold will sniff out the problems, the extensiveness of the problems. Gold's going to sniff it out. I think that's the reason why gold's been over 1,900 since March, is that gold's sniffing it out. And that if I'm right, this is going to be very, very nasty, if you will. You talked about collateral. All that collateral is basically dead, and if that collateral goes bad, the whole system starts to basically weaken. I'm not expecting a collapse, but I'm expecting to hit a wall here in the next 8 to 16 months. We got 2 more minutes, Steve.
No, I'm glad that you ended it there because you're right. You see, a business cycle is based upon decline, and then you have the energy growth to pull you out. Because what people don't realize, the roaring 20s didn't happen because Americans were really smart. They were, but we increased our oil production 154% in a decade. It doubled, more than doubled. So we produced 85% of all the cars in the world. So that was the roaring 20s due to the oil. We hit the Depression, and some say, well, it was Roosevelt's New Deal. It was World War II that finally pulled us out of that Depression. While they helped, you have to have the energy. We had massive energy growth, oil production growth up until 1970 conventional. That's when it peaked. So the issue is you go into recession or maybe a depression. And so what brings you out? You got to have the energy to pull you out. If you don't have the energy to pull you out, you can print all the money you want, but then you look like Venezuela. I've said that many times. And so I do agree with you. We're heading into a future. I don't see a collapse of the global economy. I do see a collapse of finance because we don't need it. We need food, we need energy, we need goods. The finance does no longer dictate that value. And so, but I do see a slowing up and less energy and less goods and services available. How we deal with that in the future, Don, I don't know, but I think some of the best things to hold their value will be the precious metals.
Absolutely. Not only hold their value, but appreciate and be kind of life-changing, I think, for many. I think we're basically going to somewhat recreate, as far as the mining stocks, kind of recreate the 30s and the 70s, where you just had these massive moves. We also had a massive move from, say, 98 to 2004, somewhere in there, where the miners did extremely well, and then they ran all the way to 2011. So we've had some big runs in the miners historically, but we just haven't had anything since 2011, which has been a long, long wait, and people are very frustrated. But once silver gets above $30, I think that's when, and gold gets above 2,100, I think the next run is going to last for 2 to 3 years. So final comment, Steve.
Well, Don, looks like we've got the largest number of people listening. It's a shame we have to stop, but it's a good place to stop. But the thing is, I do agree with you, because right now the psychology of the market, it's all driven by psychology. Right now, the psychology believes in the energy tooth fairy. Technology we're going to have flying cars. I see a much different future. It's going to be harder to survive in the future. And so the thing is, when the market wakes up to that, the psychology starts to change. Because look at Bear Stearns. Bear Stearns and Lehman Brothers collapsed in a very short period of time, but I could assure you the value of Bear Stearns and Lehman Brothers was worth 10% of what it was a year or two or longer before it finally collapsed. The market thinks the treasuries have the value. They believe all these bonds have the value. So they continue to invest in them like they invested in Bear Stearns. But when the psychology starts to change and the energy forces them, this stuff is not really protecting me. That's when you see people move into mines. Even though mines may produce less metal because they have less energy, they're producing real value, real assets. And I think you're right. I think that's when we're going to see this transition of moving out of finance into real things. And the BRICS are starting to push that in that direction.
All right, Steve. Hey, this has been great. I really appreciate you coming on. And for people that are out there, this has been recorded, so you can play it back if you didn't get to listen to the whole thing.
Yeah, Don, thank you very much. And I know you put out some excellent information about what the different gold and silver miners, the positives. People should look at that. And I do appreciate your time. And I think people should be really concerned with the energy, even though you're a precious metal investor. The biggest problem I have is getting people to understand the energy is the reason why you should be in the metals. And a lot of them don't. They're looking for other reasons.
Oh,
and
yeah, you made your point very well in
yes.
in this spaces. You made it really, really good.
Well, thank you. Thanks again for your time. And I want to thank all the listeners. I hope they've found some interesting information.
All right. All right, everybody. I'll see you. Bye-bye.
Bye-bye.